Well, good evening, everybody. It's fantastic to see you all here. I hope you're all well on this Wednesday evening, and delighted to invest this time with you, just trying to unpick some of the nonsense that's going on at the moment. And yeah, look, it's obviously interesting times, and interesting times call for a little bit of explanation, perhaps, as to what's going on. So, just before we start, just let me know that you can hear and see me okay. That would be great. And thanks, David. Cheers, Ewan. Cheers, Rod. That's good. Hey, John. Good to see you. Thanks, Shane. Okay, so right, we're in the business, obviously, of looking at live markets and trying to explain what's going on. And because of that, of course, just bear in mind that these are the opinions of myself, not necessarily that of Go Markets. And anything that you see or hear should be taken as part of the educational process, not direct advice to take trading action. So that important message being said, let's have a quick look at what's going on. Now, what I want to do, good stuff, Ross. What I want to do is hey, George, hi, G. Hope you got my message through, G. I had a little look around for you. G'day, GG. All is well in the West. Let's look at what's come across the news today. Obviously, we had an interesting start to the day with US equities closing at sessions low overnight. So we're expecting a little bit of a rough day on Asian markets, but it didn't come to pass. So I'm just going to quickly flick through what happened. If we just quickly look at the futures markets. Sorry, I had a little bit of a thing going on, but we can see here that we're really quite positive on the US futures going forward. Pretty neutral on the USD. Japanese yen, Swiss franc, weak as normal, but everything else is pretty near neutral. Gold and silver selling off again, and oil pretty neutral today. So remember, this is from Asian open this morning, not reflective of last night. If we look at obviously what's coming across the news that may influence this for the right now, then we're best to have a look at an economic calendar. Should come up in a moment. Knock those futures off a minute because they seem to be struggling a little bit with bandwidth. A couple of messages coming across there that saying it's struggling a little bit. But really today has been all about services PMI data. Now again, just for clarity, two types of PMI data, Purchasing Managers Index. It's really one of the leading indicators. If PMI is going higher, then it's a good reflection of where the economy is at. If it's going lower, it's not. Now, traditionally, the manufacturing PMI number has been far more important, but obviously, with COVID-19, the shutdowns have resulted in major pressure on the service industry. So this service PMI holds more clout than it would normally do. The composite is just a combination of the two. And above 50 means in expansion, below 50 means in contraction. But of course, we want to see if there is expansion or contraction, we want to see the direction of that. So if we look at the European numbers that have come across from Spain, Italy, France, Germany, we can see Germany's in expansion, but slightly shy of expectations on the composite number. That's the manufacturing data that's holding that up. If we look at the services, still contracting slightly and more contracting more than expected, whereas the others all outperformed. So the overall Euro picture is, from a services point of view, is still not particularly good. We're still got fairly major restrictions going on. We've obviously not got a lot of the service industries up and running in terms of hospitality, catering, restaurants, etc. So that's why that's suffering a little bit. So, but numbers are better than expected, and that's a good thing. We've got same coming out of the US later on, okay? So again, that'll be looked at. The manufacturing PMI data, which came out yesterday, was very positive. Okay, so let's look at let's just flick onto CNBC and just get a quick overview of what's going on. If we look at what's happening in the EU. You can see right across the board, we've got fairly significant gains. As you can see there, almost 1% across the board, and even the FTSE's up 1.2%. Look at what happened in Asia. Very strong day, particularly in China. And we'll have a look at the implications of that perhaps in a moment. And the Kospi did, create a little space here, the Kospi did better than expected as well. So good day in Asia Pacific, despite that weaker US league. Good day in Europe so far, pushing a lot of the indices up. So we also had, over this side of the woods, we had Australian GDP beat expectations on the month-on-month figures with 3.1 from memory, which is better than we thought. And of course, we've got a stimulus package being debated in the Senate this week, which is pretty crucial to life, the universe, and everything. US dollar index down, precious metals higher. So that's what's coming across the news. So let's have a look at what's happening in terms of charts right now. So we'll look at the US 500. As I said, this is since Asian trading this morning. So really sort of steadily climbed during the day without any drama. And of course, that latest step up was because the European markets have opened strongly. Put it on a daily chart for context. There's yesterday's down move, which removed about 1/3 of the previous day's gains. But you can see how choppy this is. It's ridiculously so. It's not just, and by choppy, I don't mean hugely volatile. I mean, it's intraday volatility. So you've got wide swings during the course of a day. You can see the length of some of these candles and wicks way above what is the norm. If we look at the average true range, you should see this in all its glory. So there is where we're at in terms of the ATR, which measures, and I think this is a 6 ATR I put on this. We discussed that last week, just to capture the latest moves, but you can see how much choppiness is in the markets right now. So pretty much the same as we had towards the back end of Jan, beginning of Feb. But we have sold off, and we have had a little bounce. So to answer the question that we raised in terms of what the webinar title was, this really looks like doesn't look like a major sell-off. Looks like a standard correction, standard pullback. If we look at the S&P 500 from top to bottom, then it's less than 5%. That's what we'd expect under normal circumstances, and we've seen that time and time again over the last few months in this bull market. Now, okay, and one other thing to say before we start on this this whole journey that we're going to take in the next 40 minutes or so is that because of what I've said before, that I remain a market bull. Generally speaking, that doesn't mean we're not going to have pullbacks. That doesn't mean we're going to have difficulties. But generally speaking, I think the tailwinds are stronger than the headwinds. So please bear that in mind in terms of my potential bias and where markets might be as we go through the session. But it's still quite precarious. We know it's precarious because of what happened here and what happened last night. So we're getting a day where we've got one or at best 2 days. We're not getting this nice run in one direction or the other that we had 3 weeks ago, or indeed that we had up until this point here, where we had 5 or 6 days down on the spin. We're not getting those nice little runs. We're getting 1 day up, 2 days down, 2 days up, 1 day down. That's what's happening right now, and that I suspect will continue for the rest of the week, just to give you the heads up. And the reason for that is there's still quite a lot floating around that isn't certain. So what does this mean and everything? Well, again, if we look at the Russell, this is interesting. The Russell is a small cap index that seems to be outperforming the others in today's trading, but hasn't yet demonstrated the momentum to push higher to this point here. This is the record highs we hit on the small cap index of 2,300. That's the key level to watch with the Russell to the upside. Obviously, we've got a nice downside support in place now at around about 2158, which is approximately, must be about 4% from where we are now. Yeah, about 4.85% from where we are now. So trading in a 5% range, and we're heading towards the top of that range. We look at where the VIX is on a daily chart, and I know that some of you are liking this a lot. We've got a big fat red candle again today after a little bit of a blip up yesterday. And but in terms of where we're at, we're actually in quite a comfortable place about where we are. That's a good sign to suggest that we're not up for a big sell-off right now. If we see it moving back up towards 25 again, that should be a big red flag. G'day, George. G'day, John. Hey, Chris. Sorry. Just flicking through these flicking through these messages. Good stuff. Yeah, all good. Okay, so markets appear to be as comfortable as they can be in the big picture. Okay, but that intraday uncertainty remains. There's lots of repositioning going on, and I'll tell you why that is in a little while. If we look at the US dollar, you can see there we've hung on to gains we had trading towards the top of the session. And remember, this is with the backdrop of those US equity futures going higher. So again, that's quite positive. So although there's possible downwards pressure on the USD coming in the not too distant future, one would suggest that the bottom is probably in for the foreseeable. We've got a really clear key line at 90, and we've got some wiggle room towards the bottom end should we get a big whopping stimulus by the end of the week. We may see it pull down towards there, but again, we're not clear about this, and I'll tell you why again in a little while. What that does, of course, it impacts on two things. This chart, it impacts on what's happening with precious metals and what's happening with obviously some of the currency pairs. So if we see gold, you know, I've been a gold bear for quite some time. Context is always a good thing here. So we look at the highs we hit in December, and we're down 12% from there. You can, and those were highs we haven't seen forever. So really a fairly significant sell-off. Silver not quite as bad, but obviously down again today. Looking to test support at 26.28. I'll tell you why my bearish feeling towards precious metals continues. I'm going to make some picks at the end of the session. I did this in November, and they've all actually done very well. But I'm going to do that again. And one of the reasons I'm doing that is just to show you how to put this fundamental picture together and then translate that into possibly some medium-term ideas. So if we look at some of the pairs, let's start with the US yen, because this has been quite abysmal from the yen. The yen has really been the weakest link in a lot of this in a lot of the trading in currency pairs over the last little while. You can see we're now at highs we haven't seen since August, or with the US dollar. And remember where the US dollar is in terms of strength. It's not very good at all. So the fact that it's pushing high against the yen means that most of the US dollar strength in the short term over the last couple of days has been versus the yen, not necessarily versus some of the other currencies. And if we take, if we look at the Aussie dollar US as an example, here's the daily chart. So we did have a pullback in AUD when we had that sell-off last week, but we're seeing this sort of pattern quite frequently. We've got a bounce off a key level of support at 96.92, and look where we are today. We're back challenging that resistance we were challenging at the beginning of January. And of course, if we break that, we're trading towards the top of the day at this stage. And of course, if we break this, we've potentially got 138 pips up to the next one. Let's look at a 30-minute chart just to get the latest picture. And so it looks as though we've tested that. Since Asian Open, we've tested that level at 78 cents a couple of times during the session, which also just happens to be the 200 MA on the 30-minute chart, interestingly. This is a 50 MA we're seeing here. To the upside, we've got a nice line in the sand there that says this could be the place to get interested technically. If it breaks that 78.35, then there could be a long trade on the horizon if that precipitates more buying into AUD. So if we look at euro, let's just bring a euro USD chart. Euro's lagged really significantly compared to some of the commodity-based currencies. I'll put this on a daily chart for right now. And you can see there, it really hasn't set the world alight at all. If we look at the Kiwi, if we look at the Aussie, even the GB pound, euro has lagged significantly. And that's because they're still in really quite a COVID affected state compared to obviously the Asia Pacific. And you can see that key level to the upside of 121.73. We're nowhere near that on the daily chart, but we do have some evidence of a potential bounce off a level at 120.23. Okay, let's call it 120. Let's call it 120.30. So we tested that for the last 2 days. Good move higher, but you can see we're pretty neutral today. We did look as though we're going to pop a little higher, but there's a potential. If we look at a chart, you can see what's going on here. So we've really flatlined ever since the Asian Open, and we've got a really nice line in the sand here at around about 121 dead. You know how the market likes nice round numbers. That would again potentially precipitate more buy-in and see us pull up towards this resistance around about 64, 65 pips away. So there's a couple of things going on. Look at that increase in volume. As it's particularly on this this rejection candle, these last two rejection candles didn't break through. So we're not convinced about this at all. We may see some movement once we get those service PMI numbers through as a whole, but to date, the German numbers disappointed, and that's what's dragging on the euro perhaps right now. I mentioned the GB pound, which since Brexit has done really quite well. So we had the Brexit deal done here, and we are up. Although we've had that pullback like we had in most things. Oh, come on, Mike. We're seeing a 700 pip move to the upside, around about 5% to where we're trading right now. So again, we had that pullback like we saw on the Aussie dollar chart. We had that pullback to a key support level. And this level on the GB pound was 139. Nice big round number again, the market likes that. See that bounce off there, trading towards the high of the session. This is looking very interesting on a 30-minute chart. Just take this out a bit. Let's just see if we can find something to hang our hat on. You can see quite clearly on the 30-minute chart, there's resistance at 139.92, let's say 140. So we'll get a break of 140, and we've got the potential for, again, if we get some momentum behind it in the first instance, possibly not so spectacular, but still 30 to 50 pips. But then if we break these levels at any time, then there's a big jump up around about 130 pips to the next key level on the 30-minute chart. So really interesting in terms of where that GB pound is. And if we are to get a bounce, as often happens, the equity markets have led, and we're getting some of the currencies following. And remember, this is all in the context of the Japanese yen bin week. So if we start to look at some of those pairs, here's the Kiwi. Let's put the Kiwi New Zealand dollar on this. You can see it again, same picture, dropped off last 3 days, now trading towards the high of the session, 30-minute chart, and we're breaking now. Okay, so this 78 level looks important. Okay, we put an ATR on this, or we see an ATR on this. We see it's at 8 pips. So that would take us over that 83 level there. And from then, if we look back, then we may get a pause a little way above, around about 20 pips. But there's a step up to 50 then, and possibly another step up to 90 after that. So could be, it's a really good example of how you might accumulate into a trade. If we look at the Aussie yen, look at the 5-minute chart. Let's just pop it onto an hourly. That's a bit radical, but you can see there again, there's that key level breaking through right now and looking strong. We can even put on the GB pound yen, and we're not seeing a dissimilar picture. Look at that pop that we're seeing on this candle here. Very good example of a breakout trade. There is the key level at 149.17, and this would have been the candle ideally to get in on if I hadn't been doing stuff with horses. I probably would have gone in on this trade. It's looking very tasty, and as you can see, there's a fair amount of upside in this on the hourly chart, up to around about 150 dead. Potentially put a profit target, maybe not being a greedy bugger, potentially 40 pips above where we're at now, and that looks like a potential trade of interest, which is occurring right now. Stick on the 5-minute chart, you can see that pop in the last 10 minutes as we've been talking. Okay, interesting stuff. And outside of that, well, look, if we look at shares, which we're going to look at in a minute, there's a few that caught my eye today. LYC did. In fact, LYC caught our eye yesterday when we were on the live update session. Don't miss live update tomorrow. It could be an interesting one. I'll give you the link for that and something else in a moment. But there's LYC bumping through that resistance at 6.15 yesterday, close towards the high of the session today at 6.66. So all very positive on that. Couple of other banks are going. The banks are going very well at the moment. If we use ANZ as an example, again, there's the key candle we had today. We talked about this yesterday. If we got a clear break of that 26.94, let's call it 27, and we did in today's trading. And again, we closed towards the top of the session. You can see how that MACD histogram has gone. That signal line has gone below the top of that histogram. So potentially all the ticks in the boxes. The only thing that would perturb me a little bit is we got a little bit of reduced volume today. So that would have maybe made us look somewhere else. Where else would we look? Well, we might have a look at Westpac. See what that's up to. Again, a little bit of a low volume thing going on there. Difficult to tell because of this alteration in volume, which I still haven't found an answer to. But again, similar sort of picture. We look at Macquarie, who aren't quite there yet, but could be one to keep an eye on. Look at that. That's a really clear resistance, really solid line in the sand of 147.58. So right where it closed today. Again, if we take this back on a weekly chart, you can see how important this is. We had one tried it in January and failed, but this is representing not a bad place. And why are banks doing well? Well, if we only have to look in at the US, something like JP Morgan. There we go. There it is. There's JP Morgan on a weekly chart. Let's just pop it on a daily. So we've had a massive move up in US banks over the last month or so. So there's JP Morgan up 20%, a little bit of a pullback over the last couple of days, bit of profit taking going on there, but you can see we look as though we're priming to go again. So that's where we're sort of at in terms of some of the markets. Another one I like is Caterpillar. Just again, watch this over the coming days. I think this might work, and I'll explain why in a little while as well. Okay, so that's our whiz around the chart. So what we're going to do now is try and unpick some of this stuff, because we were selling off. It looked as though Armageddon, if you listen to some of the analysts, was about to happen. And sure enough, we got a significant pullback. So one that the market would consider to be healthy, although I've never ever got that as a concept. But what happened was we had a pullback in so-called cyclical stocks. So things like resources, and obviously the commodity-based currencies followed. Things like tech stocks really got hit quite hard. I think NASDAQ was down around 6%. The Dow stayed pretty neutral. So all this turbulence, if we just put a Dow chart on this, you'll see what I mean, WS30. So you'll see we had all this turbulence going on, and yet the Dow, all it did was potter along its little line in the sand there at around about 31,600. We had a couple of days to the downside, but we've bounced back in a day. Okay, so we're back up to that level now. And so the Dow did pretty well compared to something like the NASDAQ, as I said, which dropped I think it was around about 6%, but let's just measure this. Keep it accurate. Oh, actually, nearly 9% drop, but bounced off support. Interesting place now on the index as a whole. That's the key level to keep an eye on, 13346. Actually, that's to call it 13325. Looks as though we're edging back up towards that. That was the high of yesterday's session and the day before. Be interesting to see if we challenge it again. So that's all the market con. That's where we're at. So we had a little bit of a rotation out of that. And why were we selling off? Well, the major reason that was given for this sell-off is, oh my God, look at the 10-year bond yield in the US. So I thought it was worth my while just giving you, so I'll put a little slide together to try and pick this apart so you can get it. But before we do, let's just look at where, because context is always important. So 6% in a move up of in excess of 40. So what's created the last 6 months? Well, since COVID and the major drop in March, the low interest rates has favored cyclical stocks. So things like tech stocks have done very, very well. Not only from the point of view of you've got a low interest rate environment, therefore, and stimulus packages going in, which means people have got cash. And what do they spend cash on? They spend cash on toys, particularly if they're stuck at home. And so the tech sector has done particularly well because of that. The other thing that's happened is there's been lots of money was taken out of the market, not just equities, but currencies and treasuries. It was all removed from the market by funds, and that's been sitting on the side. Then fund managers have looked at it. We'll talk about this in a moment. Thought, oh, that dividend yield looks attractive. Let's have a look at that. Then you've got some very clever companies who have essentially adapted very, very quickly to the new, whatever the new normal may end up being. But in the early days, post-pandemic, we saw a lot of re-engineering, a lot of restructuring, a lot of revenue replacement going on. So it's not just a bubble. It is actually based, or other move up has been based on companies being really smart really quickly. So we take Disney, for example. Obviously, their theme park got absolutely crucified, no income at all from them. So they invested an incredible amount of money, time, and effort into their online presence. Of course, Disney Plus being one of those that was a beneficiary of a lockdown. What does that mean? Well, it meant that, first of all, earnings absolutely smashed expectations. And secondly, it meant this. So really, the major thing that moves markets is earnings. And where are Disney? They're a Disney, okay? So let's take this right back. Let's take it right back. So that's immediately post COVID-19. Let's look at the lows to where we are now, and it's a staggering 152% higher. Why? Because everybody was expecting Armageddon, global depression, companies like Disney going under potentially. But what did they do? They got clever, they got smart, they got re-engineered really, really quickly, reinvested their efforts into this. And that's the result. Now, arguably, there is a ceiling on some of this, of course, and $200 may well be the one. You can see there's some pause around this $200 level for Disney. So I'm not suggesting that Disney are going to go higher than this, but it's a great example of what happened during those months where we were shut down. Of course, on top of that, we had positive earnings. Again, if we look at earnings expectations in April and May for June's earnings season, then they were expected to be absolutely dire already in terms of Q2, and yet they beat, and they beat by a distance. Markets forgive them with a little bit of uncertain forward guidance, but nevertheless, we had a repeat performance of that, both in October and just gone. Earnings season has just gone in the US. Companies, because of what they've done, keep on beating expectations. And we got the work from home trades. Obviously, some stocks did very well. Zoom was about as good an example as you're going to get, but Amazon, okay, so there's Zoom, worthwhile a little look at. A bit of a pullback yesterday, really rocky session yesterday, based on a couple of analysts' expectations. But again, look at where Zoom have come from, and therefore, is it surprising that we're seeing a pullback? We're a gazillion percent up. If we look at where we were, let's say there. Okay, so we're still up 180% since February last year. Now, Zoom is not going away. Okay, there'll be a readjustment. And that's what the market's already pricing in. Remember, the markets are looking forward, and that's where we're at now. So is this where Zoom will sit? Somewhere within this range of around about $100 for the next few weeks? Well, perhaps we'll talk about that in a moment too. Commodity prices have boomed. Obviously, we got this big glut in oil, and so what happened was everybody cut production. And now we're seeing, with that cut production level, some energy use come back in. Again, we're looking forward to what might happen when things open up again. And we're seeing Brent and WTI oil up at where exactly they were at the beginning of 2020. We've got change in the US government, and it's been a really interesting change in mentality of the market. Because, of course, 6 months pre-election, before COVID really hit home, then the market was very, very pro-Trump. Then it became obvious that he was a donkey, being the technical term, and there was seen as being increased risk because Trump was in power. So although there's potentially tax issues relating to Biden that the market was concerned about at the time, those have almost disappeared for the short term, simply because you'd be a lunatic to raise taxes in this current economic situation. And then, of course, you had the battles between Trump and just about every other country on the planet, which wasn't doing much for US international relations, and obviously the US-China thing the rhetoric was actually quite poisonous. Went way beyond what is happening now with Biden, which it still isn't positive, but it's not poisonously so. We've also got some resolution on Brexit, and that was uncertain. That's been uncertain in the market forever, but obviously that's been resolved. So that removal of that uncertainty has helped, and of course we've got vaccine development and rollout. So what was the impact of that? Well, quite clearly, US indices trading at historic highs, recovered much of the losses since March. Not every index, all of the indices aren't trading at that level. Let's just cryptos look as though they're having another run, just to be interesting. Looking to find a break if we look at Ethereum, but if we look at the FTSE, come on FTSE, where are you? Under F, I'm guessing. There we go. So there's the FTSE. Let's just put this into context. So we're not at all-time highs with the FTSE. We're still got around about, let's just stick on a monthly chart. So there's the FTSE. So we're still quite a distance off all-time highs. We're still about 13 or 14% from those. But we've recovered 40% of the losses we sustained at the beginning of 2020. If we look at the ASX 200, not a dissimilar picture. Again, if we sort of go back, there is the record highs. We've recovered most of those now. We actually expected this to perform slightly better, so we've recovered nearly 60% of those losses that we sustained in February, March, but still underperforming. We need to see a break of that 7,000 level. And as I said, although the ASX was one of the places to be that I predicted in October pre-election, you can see it's done pretty well since then. I mean, it's up 8%, but it's way underperformed the other indices globally. Now, the other one that's been of interest, I don't think I've got it on here, but yes, I do have it on here. Here's the China 50. Okay, so here's the China 50, and we'll go back to the beginning, or back to COVID, and we can see there it was. We have had a pullback, but we're still up 63%. Okay, so let's just get closer. So the pullback on the China 50 was quite significant compared to some of the other indices. So it underperformed in this latest pullback, down almost 12%. But you can see now we look as though we're about to rock and roll. What is beneficial about China? Well, look there. Irrespective of where the vaccine, irrespective of where the virus came from, China have managed it almost as well, if not better than anybody else. The Asia Pacific is in a good place. There's a good trade agreement in place between most of the major countries in the Asia Pacific, and we are looking quite positive going forward. And obviously, China really important to Australia. So this could be one of the beneficiaries going forward. But really, again, we're talking a pullback which is understandable. Cyclical stocks outperformed until recently, and of course, I've shown you the pullback in that. We've got that rotation into value, and this seems to be the way of things. Every time there's a pullback, tech stocks seem to suffer a little bit more than the rest, and we get a little bit more rotation into value stocks. The banks in the US have done particularly well. So outside the service sector, it's done pretty well, and we've got small cap stocks recovering as well. Transport and service still lag. US dollars and USD and precious metals are still lower, and cryptos have surged, although they've had a pullback lately. Commodity-based currencies have done pretty well. We look at the AUD, and I must admit, I was expecting the Reserve Bank to possibly to start twitching about this a little bit. But if we look at where the AUD is, let's go monthly. Okay, we're still way off our highs, but this strength here is obviously the stronger the AUD gets, the more or the less competitive companies in Australia are. So I'm wondering whether if it breaks 80, that's the stage where the RBA just starts to make noises. I don't think they'll intervene, but they may start to make noises about we need to keep an eye on this. And as soon as they start to do that, then we just may see a little bit of a market twitch, but in the short to medium term, they still look strong. They still look strong, and of course, there's about 250 pips up to this point. So in the short term, there's no evidence of this slowing down. And of course, you don't just look at one currency; you look at its performance against other currencies. And with the euro struggling, with the yen really struggling, with the US dollar in an ordinary place, then if commodity prices still continue to go, base metals prices particularly, then you would imagine that this move would be supported even more. And of course, we've still got accommodative central banks. When everybody was getting really upset about bond yields, which I'm going to talk about in about 45 seconds, up popped the Fed, said, hey, look, it's okay. This inflation thing is soft. We're not seeing any evidence at all in CPI data that inflation is rising. It's possibly the market's getting a little bit ahead of themselves. Just chill. Okay, that's Fed Chairman Powell. That was a bit of a Mike-style summary of what he said. But essentially, the market liked that and just calmed things down a little bit. But it is still in a very precarious position because bond yields are a real driver in terms of investor behavior. Why is that? Okay, so let's look at the big deal about treasury yields. Okay, let's just make sure you've got some clarity on this and why you need to keep an eye on this. Now, normally I wouldn't give a monkeys about treasury yields, but every now and then it pops up. It's been an issue. Now, the standard is that government bonds are traditionally seen as safe, lower yield investments. So normally you would expect a fund, a managed fund or a mutual fund, depending on where you're at and what you call them, hold a proportion of bonds within the portfolio. And certainly if you talk to any financial planner, they'll sort of say, oh, well, you need to have some of your money in treasuries. So what treasuries are, essentially they're government saying, well, look, lender, give us some money and we'll give you a guaranteed return. Okay. So, and there's lots of different sorts of treasuries available. I think they're called treasuries up to a 10-year, and then they're called bonds after that, but really they come under the bond market. The 10-year is really, really important. The 10-year is the one that mortgage rates tend to be based on. And so the 10-year is the one that most people would look at as the benchmark. Okay, there's a few interesting things happen with bonds from time to time. You'll hear people talk about an inverted yield curve, where maybe the 2-year and the 20-year are high and the 10-year is low. That's usually a sign of major inflation or major inflation coming, because again, these are forward-looking, because they're dated 10 years to expiry or 1 year to expiry. And there's continual auctions. Obviously, a 10-year that was released 10 years ago will be expiring today. And so every month there's some, depending on how many the US government want to release. There's always auctions going on, and depending on where the economy is, you'll get people investing in these at various prices. And because they're a tradable instrument as well, because you don't have to hold them for 10 years, you can trade them like anything else, then that's where it becomes important. And the yield or the interest rate that you paid for holding bonds is pretty critical in terms of how the stock market moves on, looking to the medium term, okay? So the bottom line is that if the economy is not in a good place and stocks, then what happens? Let's say it's getting too hot, and the Fed says, right, okay, I'm going to have to, or the Reserve Bank says, I'm going to have to raise interest rates because there's bonds released by every government. Okay, so there's Aussie bonds as well. So what happens is people see that this inflation is happening. They see house prices going through the roof. They see jobs numbers coming down to levels which are beyond the norm. And so what they think is, well, look, the Reserve Bank is going to have to just cool the economy down a bit fairly soon. So interest rates are more likely to go up. So therefore, yields in bonds rise. Okay. And so you've got a yield there which can go up and down. And that's always compared to the dividend yields that you get from stocks. And what we mean by that, if you're less familiar, is let's say you've got most or many stocks will pay dividends. And what they'll do is they'll pay an X amount of cents per share that you hold. Okay. And then that is calculated as a percentage, and that's your dividend yield. So here's what happened, right? What we got is, after COVID hit, we got dropping bond yields as central banks scurried to drop interest rates time after time after time after time to take them to almost zero. We got bond yields, a 10-year bond only dropping to 0.35. Certain days in the month, and you can, so bond auctions at certain days of the month, and you can see that on an economic calendar. It's one of the things that's reported. So we got dropping bond yields to 35%. And so let's say we had an XYZ share in the US that was trading at $10, even though it dropped, paid 50 cents a share dividend. Now, we had a lot of stocks actually say we can't pay a dividend right now in March. So that gap wasn't significant in a lot of cases, but as we got some good earnings in June, we got those who weren't paying a dividend starting to offer a dividend again. So let's say stock XYZ was paying 50 cents a share. Is at $10, that's a 5% dividend yield, okay? So if you were Mr. Managed Fund, you look at these two investments, all you have to do is XYZ stays solid and it gives you 5%. So if it doesn't go down from here, and certainly once April, May, June was here, the worst people were talking about was essentially an L shape. They weren't talking a K shape or any of that sort of stuff. In terms of the recovery, there were signs of a recovery potentially happening, although they were perhaps a little optimistic in timing because people underestimated the dramas that would be created by a second and third wave of COVID. And so if you were a managed fund, where would you put your cash? You'd put your cash in stocks, because you have got to get your investors in your fund as good a return as possible. So why would you have a lot of money sitting in treasury yields when you could be earning 10 times or more on a dividend yield of stocks? So that being the case, what's happening now? Rising bond yields. I'm going to show you a chart in a moment to show you the extent of this and how dramatic it is. So that 0.35, I think, was the lowest close. Intraday actually dropped to 0.31 at its worst. So what's happened is the stock market's gone up and bond yields have started now to follow. So we've got XYZ is now not at $10, is at $20. Okay. So that 50 cents a share that it's paying a dividend is now not 5%, it's 2.5%. Now, bond yields are now, a 10-year bond is now at 1.41, at least it was the last time I looked. Obviously, it's a tradable instrument, so it'll go up and down a little bit. And so now the gap is only is less than 2, okay? So now some of managed funds are saying, well, hey, look, that's maybe not a bad place to have some cash now. So it's just crept up and crept up and crept up. Now let me show you this in reality. So here is a yield chart of the 10-year over the last year. Okay, so you can see there's the low. Okay, there's the low at 0.318. Okay, now again, traditionally, let's just see where this sits. So traditionally, you can see how low this is. So early 2000s, we'd expect 5% on the 10-year. Okay, even over the last 5 years, the average has sort of been around, when interest rates have been low, the average has been around about 2.5 to 2.6%. But you can see, if we just look at this 1-year chart, all of a sudden, over the last 4 months, we've had this fairly significant rise. As stock prices have risen, then dividend yields are getting less and less attractive. Bonds have been really, so bond yield, in the same way that a dividend yield relates to how expensive a stock is. We look at what's happened to bond yields. This is the ETF for the 7 to 10 year, one of the ones you can trade in the US. But you can see how this has dropped in value, dropped in value, dropped in value. So by a significant amount again. So if prices drop on anything that has a yield according to, then that yield per price of the underlying instrument is greater. So that's what's happened. Bond prices, it's now more attractive to buy bonds at these prices, and hence than it was up here when there was no yield. And so this drop in price has partly created this increase in yield. Now, the ceiling on this is created by the fact that there isn't any immediate prospect of interest rate rise. Remember, I said that the major driver of bond yields is what central banks may or may not do, which is based primarily on inflation data and on jobs data. So investors saw this rise in bond yields and automatically assumed that this was a sign of inflation to come. Okay, that what we're seeing in the 10-year, in that increase in yield, was potentially inflation on the horizon. And the Fed, who have said, right, we're going to do nothing until 2023 in terms of interest rates because the economy is not in a state to deal with it, all of a sudden, this increase in bond yields and the inflation suggests, well, hey, look, the Fed might actually do something earlier than that. Remember, everything that's known or thought is priced into the markets already. So the issue is, of course, that if we look at CPI data, and I don't know whether I can find, I should have checked this out, sorry. Let's try and find some CPI data somewhere. Yep, there we go. So there's CPI data in Germany, okay? Nothing, 0.6%, okay? That's actually dropped from last month. I thought there was some other CPI data out last week, but I might have been wrong. Okay, it's not a very good thing, but here we got CPI data out of Switzerland. It was expected to be this, oh sorry, it was this last month. It was expected to be lower this month, and it didn't. It sort of, so lower than expected. Okay, so that's the inflation data that's come across, and then of course you get Fed Chair Powell coming up and saying, hey, chill, it's all good, it's all okay. So I hope that's explained the relationship a bit. Now, obviously, it's not the only thing that moves markets, but it is a key thing that has an influence. So, reality is stocks look less attractive and inflationary concerns if we see the bond yields rise. The reality is, of course, that that's not it. Now, so going back to the title of the thing, so what's next for these cyclical stocks that have been bashed around a little bit? What's going to happen to the Apples and the Amazons and the Netflix and the Googles and the Twitters and the et cetera, et cetera? Well, here's the reality. What happened? One of the key things that happened with the pandemic is, we're coming on to those stock and FX picks in a moment. One of the key things that happened is tech innovation took off through necessity. So things that perhaps would have taken 2 or 3 years to actually get in circulation and get being used by the public all of a sudden happened in 2 or 3 months. Because that's where all the energy and investment went. Tech companies saw the opportunity. Investors saw the opportunity to help things along a little bit. And potentially things, I mean, if we look at the number of times Zoom has changed, for example, over the last 9 months, it's quite staggering. So tech companies were prepared to put products out and then alter them as they went. So unprecedented acceleration in tech. So the tech bubble, the tech 2000 comparisons are really nothing to do with what happened over the last 9 months. Just because we saw tech go up in 2000, we saw then that automatically, and of course, and illogically means that that's going to happen again. And of course, that work from home thing helps a lot of things along as well. I had lots of time to play computer games, to watch TV, and nothing else to spend our money on because I couldn't go on holiday. So, but many businesses, as we've already talked about, have restructured revenue streams and the way employees work. But the overriding question is, well, how much will remain with a new normal? Well, businesses, I would suggest, are still going to. Businesses now have evidence to say, well, look, we've seen that we can still be productive if some of our employees work from home. We can keep costs lower in terms of accommodation for our business if we have a rotation of staff. Now, we're not going to get companies completely reverting to or staying at work from home, but we're going to get a lot of it, or a lot more flexibility within that. The new tech innovation that's happened is going to be kept in place and continuing to rise. And of course, we've had earnings support to back this up. This is not without fundamental basis. Okay, but there may be a perceived ceiling compared to the battered service sectors in the sort of short term. So remember, we talked about that rotation out of tech into other sectors. As the economy recovers, as there's evidence of a recovery, then if we look at Apple versus an airline, you would say there's more upside potential in the airline, perhaps, or although a lot of that is starting to be priced in. There's no inflationary pressures, and everything that's thought about inflation has been dampened down by the Fed. They've been really quite bearish on economic recovery, more so than the market, and that of course has kept a little ceiling on some things. And here's the other thought. Maybe only a handful of years ago, a lot of the tech innovations were seen as consumer discretionary, so luxury items, things that you'd only buy if you could afford. However, because of the way things have changed, and whatever this new normal looks like, then perhaps tech has moved from coming under consumer discretionary, where it often sits, to consumer staples, which means it's one of those things that are pretty high on the priority list in terms of spending. So although tech has outperformed and may have a temporary short ceiling as we see a bit of rotation, or perhaps more of that money that's sitting on the sidelines still being used for value because of the upside potential and people trading in and out. In terms of the medium to long term, There's no reason to suspect that those big tech companies that we've talked about are not going to continue to do well. Even when there's legislation fired at them, they seem to recover. Now, the other subsector within the tech sector is microchips. And the microchip shortage, because moves towards electric cars, moves towards this increase in tech generally, are all driven by microchip technology. And there's a global shortage. Porsche, or Porsche, depending on how you say it, have actually had to cut production because people want to buy motor cars now because some people are cashed up because they're not going on holiday. And with interest rates at an all-time low, so people think, oh, maybe now's a good time to lock in a new car. So let's phone Mr. Porsche up and say, hey, look, give us your 911. And I think that's one of the more popular Porsche models. I'm not a car buff, but I seem to remember that from years gone by when I used to play top trumps, etc. That's a blast from the past, isn't it? So, but even Porsche have had to slow down production because of a microchip shortage. So does that create a potential opportunity in the short term? Well, which are the microchip stocks? Well, they don't exist in Australia, obviously, but if we're looking in the US, we can look at stocks like Broadcom, trading towards a high, just waiting for the next little pop. Just keep an eye on that. If it breaks 490, we could look at one of my favorites is Micron. Again, a little bit of a pullback could be an opportunity here. Trading at highs not seen before. Look at all of those lines. Let's just get rid of some of those because we're going to have to look at some charts again now. Okay, and we'll look at Nvidia, which are big into the gaming sector. Pullback, but look at that buying. Oh, let's just let it catch up. So look at the support that's in there. Is that perhaps it's had 1, 2, 3, 4 attempts, 5 attempts in the last 6 to break through that 534 level without success. And then we've got Apple designing its own stuff. Again, let's just let's catch up. So again, we've got a bounce in tech again. So is this now, has this pullback said, hey, well, look, now that's enough, let's get back into tech. So maybe that ceiling is further away than it has been for a couple of months. So what does all this mean? Let's bring it all together and say, well, look, let's look at the headwinds and tailwinds for right now. Of course, we've already mentioned bond yields. If they start creeping up again, we may get a bit more twitch in the markets. If we get this stimulus package not passed, the markets will not like that at all, and that's possibly been one of the drags. We've got unemployment insurance expiring in the US on March the 14th, and so there is some urgency about this 1.9 trillion stimulus package. Now, it may not be quite that much, but markets already priced that into some degree. How much is uncertain. But the reality is, once that's passed, we'll see a market pop. And we'll see a pop in a number of key sectors. We may also see, as we've said before, we may also see some downwards pressure on the USD in the shorter term. And we'll see infrastructure and perhaps consumer discretionary both doing quite well because of the extra money that will be in people's pockets. Additionally, the infrastructure spend is going to put pressure on already significantly high base metal prices, and with a lack of inflationary pressure still apparent. And let's just have a look at gold, because I'll tell you, if we just pop gold back on, I should have said this before, but the reason we had this move, sorry, not silver, the reason we had this move between, let's just go right back, there we go. The reason we had this move between March and September was there's all this money being printed, and therefore there's bound to be inflation. Okay, that was the rationale, and that's what created this. It's interesting that we've dropped now in excess of 50% of that move up when there's been no inflation. So I expect the pressure to be downwards on precious metals, despite the potential short-term US dollar dip that we might see. Now, markets are already pricing in continued recovery post-vaccines, but any better vaccine news is good. There's another one coming on the market now, which is going in front of the FDA in 3 weeks' time, I think. The J&J vaccine is gaining popularity because it's a one dose and getting things in people's arms quickly. And it appears as though all of these vaccines seem to have some efficacy, not only against the original strain, but all these variants that are popping up. So the more of this that comes onto the market, the better the distribution systems are, the more the UK have done exceptionally well in getting vaccines in people's arms. And that's maybe one of the reasons the GB pound is looking okay, compared to, say, the euro, where that's not happening to the same degree. So that's, even though some of that's priced in, it's expected that it's going to be sort of middle of the year and perhaps a little bit beyond that when we start to see some major stuff, or some major significance in some of those travel stocks and service stocks that's been apparent over the last little while. So our picks for Q2, or Mike's picks for Q2, because it's not ours. I can only see the Aussie dollar and New Zealand dollar rising. I can't see any other logical explanation or logical outcome from a little bit of US dollar weakening in the short term and continued base metal prices doing well. There's no other reason to suspect anything else. The caveat on that is obviously we've got a potential situation where if there isn't a stimulus package passed and we do get the US dollar strengthening, we do get increasing bond yields, we shall see the US dollar strengthening again, then we could see some more pressure on commodity-based currencies. But at this stage, that's when I'm planting my flag. With the indices, I still like the ASX. I think that's underperformed to where it should be. And the Russell 2000, the more we open up, the more small cap or smaller businesses will benefit. But I think all of them will be positive. I just think the ASX and Russell 2000 may outperform, even though the Russell 2000 has a lot of that already priced in. And then I put the China 50 because I wanted something that was a little bit off the wall. Again, if we go back to that China 50 chart, let's just see what's happening quickly. Oh, US. There's that GB pound yen. That's dropping off a little bit in the 5-minute chart, but still looking okay on just about every other chart. Since we've been on, sorry, I shouldn't get distracted, should I? If we look at the China 50, as I said, I think we've hit a bottom on that for right now. I don't see Biden being very aggressive, although he's making the right noises to keep the US happy. That 18927 is probably the point at which a medium-term trade might be good, and you can see we've got a significant upside potential in this of around about 8 or 9% in the medium term, and I wouldn't be surprised to see it go higher from there. At all, because of course they've got they and some of the other countries in the Asia Pacific have got the head start on everything else. There's a definite shift of economic power into China, so that's why I think there. ASX, I've mentioned Macquarie already, and I've mentioned Qantas already. Two of the stocks that I still like. I still like Zip, even though it's got battered. We've got two of these stocks. Afterpay is strongest fundamentally, or is strong fundamentally, but really has pulled down as far as I would have thought is reasonable for it to pull down Lots of upside in this. Really strong fundamentally in terms of got a big US footprint. The earnings they released, which caused this drop here, sort of the losses were, because it is a company that's in loss rather than in profit. And I think that surprised the market a little bit. I think they were expecting a slightly better performance. Zip is the alternative, of course. Zip Pay is quite sort of in there. We've had a similar sort of pullback with them over the last little while, down about 30%, but that's on the back of a let's just take it back. Oh, let's not take it back too far. Why are you doing this to me? Okay, let's just pop on a weekly chart. Sometimes that's easier to see. Oh, it's not giving me enough data. Okay, so but we can see that even since December, when Afterpay was starting to get a little toppy, Zip was seen as less strong fundamentally, and that's why it traded at $6, not 150. But since then, of course, it zipped up, to around about 130% higher. So to get a 30% pullback is not surprising at all. And as you can see, we're putting in a potential support there. I think Zip possibly has the greater upside than to Afterpay for two reasons. First of all, I think 150 for Afterpay is probably priced in all the good news. So although there is a $20 to $25 up move in that, which represents around about 22%, I think the cheaper price of Zip mean it's more accessible to more investors is possibly one of the things that would help this higher. In terms of a reason to get in, $11 looks like a reason that would technically be supported, as that would create a double bottom formation. Macquarie I've already mentioned. Now in the US, we've mentioned Caterpillar, we've mentioned Zoom already. I don't know whether we had a look at a Zoom chart. Yes, we did have a look at a Zoom chart. But just in case we didn't, let's just pop that on. So really we're struggling to find what the new normal may be for Zoom. Look at this 200 moving average, but you can see where it's done. Now, I wouldn't expect it to be back up here around 560 in the near term. And again, there's a nice $400 key level there, which would be of interest. That would be the, so even if you've got a long fundamental idea, it doesn't mean you throw technicals out the window. But I would certainly see it up around about this 500, I think there's $100 in this, which is around about 25% in the medium term as businesses bed down as to what this means going forward. A lot of institutional buying coming into this right now, whenever there's a dip. It'd be interesting to see what it does tonight. And then another one was Microsoft, which although aren't quite as exciting possibly as some of the others, Microsoft are very, very strong fundamentally, got a very, very good model. Don't seem to be under any political pressure like Google or Facebook are. And you can see there's that next move higher. We've got now a nice support in after a retracement at around about 229. So in the first instance, this is one of the underperformers from November that I said, but it's still done better. If we look at where it is now to where we're in October. So it's moved up around about 10%, which isn't shabby. Similar sort of move up from where it is now, 5% in the first instance, but I can't see any reason why Microsoft and the business model have got won't continue to excel. And so that's why that's a slightly safer bet, a slightly more measured bet, but nevertheless one that may well, I suspect, do quite well over Q2. So obviously we'll come back and have a look at all of this at the end of Q2, and you can say, I told you so, or whatever the good alternative of that is. Okay, so we've been going for quite some time, so that's it. I just want to put two things in front of you which are exciting. First thing is let's get you at two things going on. Obviously, first steps isn't for you. If you're not in a live update, the next session is tomorrow. We'll have a review of what we've been talking about. Let's have a look at some of those stocks as they come today. So if you're not part of that group, I'm going to put lunchtime, because that's when it is, in. But the major event over the next week, you may already have got an email about. Now, you know, we've been doing these trader clinics, these intermediate trader clinics, which essentially are supplemental to the Next Steps program. The next one is on Monday. We did trading plans, I think, for 2 sessions, and then last month we did trading performance. This time we're doing some mind stuff. So control your mindset, control your results. Wow, that's a really impressive. There was an email, as I said, went out about this today. So make sure you get your place locked in on this. We shall just pop it in there. So I'm going to call that mindset. And look, register anyway, even if you can't make it along on Monday, because we'll be sending emails out with recordings and all that sort of stuff. So good stuff, Wayne. Glad to hear you're already in. So I'm going to leave those up there for a couple of minutes so you can lock those in, just while I have a look through questions. Just want to just having a quick look through now. Gary, or Gigi, you have a good one. Yeah, I must admit, I thought the ASX might do better as well today after good GDP numbers, but it's early yet. You take care, mate. We'll see you soon. Any more thoughts on USD, Japanese yen? Let's quickly have a look at that as a chart. Yeah, look, I see that really challenging that hard. It's pushing right up against that 106.93. 107 makes sense to me. Although I'd probably prefer the one of the commodity George, thank you so much. That's really nice feedback, mate. Really appreciate that. I'm just having a quick look around. I hope that was, anyway, look, I hope that was, and no worries, Alison. We're great to see you there. Any idea why that, oh, okay. 2,000 candle. Any idea why we had the spike on the candle on GB pound New Zealand dollar? Let's just have a quick look at that. The 2,000 candle, or 2,000 candle, I'm guessing that is. This one here, I'm guessing you mean. I'm just going to see what. Wow, no, I've no idea why that happened. I can query that. Certainly, if you're ever on the receiving end of that, I'm just trying to see what time frame it was over. If you're ever on the receiving end of that, which it's certainly worthwhile querying if you're obviously if you were long this, or sorry, if you were short this, you would have done exceptionally well. But that's within like a couple of minutes. I've no idea, but if you ever see that, query it with the trading desk, and they can often resolve that plus any issues that are created by that if you're in positions already. I'm sorry I can't offer more guidance on that at all. What time was that? That was trying to work out what time it was, our time, not platform time. So, well, it was middle of the night. Not really sure, sorry. But that's a substantial move. Whoa. But we've had those candles before, but very unusual activity. We had a candle of similar length. Actually, not even quite that, from top to bottom. Yeah, similar length there. Let me just see what time of day that was. Around about 1700, so not the same time of day. But yeah, interesting nevertheless. Sorry I can't, but look, I'll query that and see if I can get an answer for you, if that helps. All right, guys, well, look, that's probably good for today. I think I've answered everything. You're welcome, Adrian. Brett, thank you, mate. Really kind feedback. All New Zealand crosses are the same, so it was a Kiwi issue rather than a, thanks Ian. So it was a Kiwi issue rather than GP. That's really useful to know. Okay, guys, well, look, take care of yourselves. We'll see you again very soon. Thanks, Rod. Really appreciate that. Light bulb moments from Wayne. Fantastic. Good stuff. That gives me a real kick, because obviously I like to know that I've even just helped uncloud a few things that maybe aren't out there and talked about very often. Anyway, take care of yourselves. Trade safe. For those of you rocking up to the lunchtime session tomorrow, I will see you then. Enjoy the rest of your evening wherever you are, or the day if you're in the Middle East or Europe, which I know a few of you are. And we'll catch you very, very soon. Bye-bye for now.